All right, folks, step right up and gather around. In the grand circus of life today, the clowns are running our country and all the tightrope walkers are on Wall Street. Meanwhile, we've stumbled upon something so absurd, it's almost hilarious. The benefits of a housing market crash. Yeah, you heard me right. It's like tripping over your own feet and landing in a pile of money. Only in this crazy world, I tell you what. So, let's call in the dancing bears and see what tricks they have planned for our housing market. Don't go away, it's gonna get crazy. This is Real Estate Rundown. Here we go. As the predictions swirl and the wind of economic uncertainty howls, one can't help but wonder what would happen if the housing market actually tanked. Would it devastate our financial well-being? Or could it possibly make homes affordable again? The housing market is a complex and vital part of our economy. It is influenced by a myriad of factors, including interest rates, employment rates, and the overall health of the economy. In recent years, we've seen prices soar to unprecedented heights, putting the dream of homeownership out of reach for many. But as history has shown us, what goes up must come down, right? The real question is, how would a downturn affect us today? Well, first, let's consider the role of interest rates. In an effort to combat inflation and stabilize the economy, central banks will raise interest rates. This can cool down an overheated market, but it also means higher mortgage payments. For prospective buyers, this translates to increased borrowing costs, potentially sidelining them from making a purchase. Homeowners with variable rate mortgages would see their monthly payments go up, squeezing their budgets and possibly leading to higher default rates. Employment rates are another critical factor. A strong job market typically supports housing demand, as more people have the financial security to buy homes. However, in the event of job cuts and layoffs, rising unemployment would likely kill the demand for homes. Those who lose their jobs will struggle to keep up with mortgage payments, creating higher risk of foreclosure. The fear of job loss in and of itself may deter potential buyers from entering the market, further dampening demand. The overall health of our economy is significant as well. Economic growth encourages investment and supports the housing market. But in a downturn, inflation reduces consumer spending and business investment, which contributes to a decline in housing demand. Less demand is a leading cause of falling home prices, erasing years of equity that homeowners have built up. Anyone looking to sell in these conditions will experience high levels of anxiety while their home just sits on the market for longer periods. Or depending upon their situation, they may have to accept a deal at a huge discount or even sell at a loss. On the flip side, a housing market crash presents opportunities. For those who have been priced out of the market, like first-time buyers, lower home prices could make homeownership more accessible for the few who are prepared to take the leap. And there's always some investors with cash in hand who are ready to pounce during a downturn, scooping up properties at a discount, placing their bets on a future recovery. However, the impact of a housing market crash in today's conditions could also have broader economic implications. A significant decline in home prices can lead to a decrease in household wealth, affecting consumer confidence and spending. This cascade can slow economic recovery, leading to a vicious cycle of declining demand and falling prices. Additionally, the housing market is interconnected with the financial system. If people are unable to keep up with the rising costs of literally everything, then it creates a tsunami of debt, defaults, and foreclosures that could strain banks and financial institutions, potentially leading to a credit crunch. This would make it harder for businesses and consumers to borrow, further hampering economic growth. Deja vu 2010 all over again. It's important to maintain perspective here, as the housing market is not a monolith. The impact of such events will vary by region, with some areas experiencing sharper drop-offs than others. Factors such as local employment rates, population instability, housing supply, and political turmoil all play a critical role in determining how a downturn affects a particular market. Okay, Now that we know what the downward spiral looks like, let's examine some of the factors that have prevented the proverbial crash from happening. How about we start with the golden handcuffs? This is a term used to describe why homeowners hesitate to move. Selling their homes could mean giving up their low 2% and 3% mortgage rates, then taking on higher rates around 7% or 8%. Many potential move-up buyers find this to be an unattractive proposition and are opting to stay where they are. A recent report from Redfin says that homeowners are staying in their homes nearly twice as long as they did 20 years ago. When masses of people are unwilling to sell, it chokes off the supply of available homes. Another factor is the robust demand for housing. Look at the demographic trend. The millennial generation is just now entering their prime home buying years and represent a substantial demographic force. Their demand for homes, fueled by the desire for more space, particularly in the wake of the global pandemic, could continue to support the housing market in the foreseeable future. This demand is further bolstered by low unemployment rates, rising wages, and financial savvy, which enhance their buying power. As the supply of housing remains constrained in many areas, there is a legacy of underbuilding in the years following the last financial crisis. This shortage of new construction and pre-existing inventory, especially in the face of strong demand, could help to sustain prices even if economic conditions weaken. The simple theory of supply and demand suggests that as long as there are more buyers than available homes, the market is unlikely to see a significant crash in prices. The quality of mortgage lending could also help mitigate the impact of a downturn. Unlike the pre-2008 era, today's lending standards are much stricter, with borrowers required to have better credit scores, more stable income, and, in many cases, larger down payments. This improvement in lending practices means that homeowners are generally in a better position to weather economic storms, reducing the risk of mass defaults and foreclosures that could precipitate a housing market crash. As we all know, the global economic outlook is fraught with uncertainties. Geopolitical tensions, wars, trade disputes, and the seemingly never-ending challenges of managing post-pandemic recovery efforts could all influence economic conditions worldwide. These factors, combined with domestic issues such as the upcoming 2024 elections, open borders, and relentless congressional spending, might impact consumer confidence and spending, and will likely have some effect on the housing market. During these uncertain times, the housing market remains a barometer of broader economic health. While there are clear risks that could lead to a downturn, there are also strong fundamentals and mitigating factors that would prevent a crash. The balance between these opposing forces will determine the future trajectory of the housing market. So, given all the factors at play, do you think the housing market will really crash this year, or will it sustain the challenges to maintain stability? Your insights and perspectives are valuable as we continue to explore this critical topic. This is Real Estate Rundown. Please join us again next time.